Well, the effects of portfolio size on returns are well documented in markets across the globe. For large Western markets, one could purchase far larger quantities of stocks without impacting on portfolio performance, whereas in markets with more limited liquidity, this becomes an issue far quicker. Is there an easy answer to the ideal portfolio size here in South Africa? Let's delve into this, crossing over to Cape Town now. Linda Eads joining us there from our Cape Town studios. Linda, thanks so much for joining us today. So, I mean, when we're on the show here, we always introduce funds and we talk about the fund size, and that, of course, is relevant. That's what we're talking about tonight. So tell us really what spurred the research into this area.
Well, what you're looking at really is the assets under management of the entire firm, assuming that they take similar equity positions across their funds. Obviously, some asset managers have specialist portfolios, and there the fund size is the most relevant thing. Why we looked into it was, as absolute value managers, we want to have the widest opportunity set available to us in order to find those cheap, undervalued stocks. And that is a bit of an issue in the South African equity market in particular, which isn't particularly deep. And as you gather assets and your portfolio increases in size, you start to become constrained at some point in terms of finding absolute value. And for us, we wanted to see firstly what advantages we had being one of the smaller asset managers in the South African marketplace today. And indeed, at what point should we start to be concerned with regards to the size of our assets. So that really was what drove us looking into this.
Let's just talk about the industry as it stands right now, the number of funds that we have, and of course the size of those funds overall.
Yeah, I mean, let me just quickly, Linda just now mentioned what she calls portfolio depth. And portfolio depth literally means the ability to be able to pick stocks across a wide horizon. That's breadth. And then the depth is to be able to buy into the stock without necessarily manipulating or moving the price, so to speak. And we're going to be looking at some research that ReCM has done in this regard. Remember that for an active manager, finding undervalued opportunities and finding the ability to buy those makes a massive, massive difference to creating alpha long term. And that generally, we've always said, is better at smaller asset sizes than larger asset sizes. But now, just have a look at the industry, and I just want to show you how the industry has actually changed just, well, since the beginning of when unit trusts actually existed. If you have a look there, you'll see the number of funds that are available in the South African market. Look how slow the start is when you go back to the 1960s. You can see the very, very slow start here for funds. And just look how it's just catapulted. We've got very close to 1,000 unit trusts available in the industry today. And if I take the number of funds available relative to the total size of the industry, look at the average size of the average fund that you can buy today. Well, it's close to 1.8 billion rand as far as that overall size is concerned. And you can just see it's been rapidly growing over time. Hence, the number of assets available in the average fund today is much larger than we've had, say, for instance, 5 years ago, 8 years ago, even 10 years ago. How does that influence returns? Very, very important question.
Yeah, I mean, Roland, what is your overall view on this topic? I mean, where do you stand when it comes to the value of staying small in the industry?
I think every fund manager would like to get as much assets as they can because it's business for them, but they also don't want to have too many assets because then their performance will be affected. And that kind of trade-off is actually a very difficult business strategy decision, and some large funds are actually closing their business to new clients because they just cannot deliver that performance anymore. And knowing where that sweet spot is clearly critical. But it must be one of the toughest decisions an asset manager can make is, you know, shall we actually stop taking business to preserve the existing client's performance?
You see, I mean, more the boutique managers I see get to a point where they close funds and they say, look, you know, quite frankly, beyond this point, we don't know if we can create the returns that you've come to expect from us over time. So therefore, how do we control this? Well, quite frankly, by closing a fund, waiting for people to redeem some units, and then potentially opening it up again. Another tactic to deal with this is potentially opening up a B fund or a C fund, and you're trying to mimic exactly what you do in the A fund. But the problem with that is that you literally just it's another
same fund, basically.
It's basically the same fund. Now, I mean, ReCM did some research around this, and Linda, maybe here's a question quickly for you. You guys decided to work on what is called the 20% free float available in most stocks. Just tell us about how you guys came to that number and why that is an important number to take into consideration before we look at the research more closely.
Okay. Well, the free float, first of all, are the shares that are available in the market to be traded. So what that is, it excludes sort of strategic shareholding, which is unlikely really to trade hands, shareholdings by directors, for instance, or by parent companies. So it's really what is available out there to purchase. Now, in speaking to a number of dealers, market participants who really at the coalface there, we sort of said to them, at what point do you start to face liquidity issues when you're holding a particular percentage of the free float? And the number that was sort of agreed upon, the sort of consensus is above 20%, you really are starting to have difficulty getting in or out of a position without having liquidity issues which impact the price.
And I mean that's really the starting point for the research. I mean, you could potentially increase that to 30 and 40%, and maybe there's different answers for different parts of the market. But let's just show the viewers what the first kind of viewpoint as far as the research is concerned. Have a look at that graph over there. So firstly, what ReCM is doing over here is they're assuming that 20% of the free float is tradable. And it secondly assumes that you're going to be taking a portfolio position of 1%. That means you're going to be taking, out of different asset sizes that you're managing at the bottom end that you can see over here, you're going to be buying 1% in each stock that across the universe. Now let's assume you have a 50 billion rand portfolio. What is the number of stocks that you could potentially hold? Well, only about 100 stocks that you could potentially hold. What does that mean for a total universe? Well, it's basically only 60% of the total universe that you can buy. And you can see how the total universe drops and drops and drops and drops off as the asset sizes get larger and larger and larger. Hence, liquidity becomes a problem, and the fact is you can't move that asset size around the market that easily anymore.
Because of it being so small, so it's a limiting factor. Any points to add on to this, Linda, in terms of where you stand right now? I mean, how do you get around this? What conclusion have you come to when it comes to the ideal size?
Well, the first thing I want to point out is that this was the very optimistic scenario. So to consider 1% a meaningful position as defining your opportunity set, to say if I can get at least 1%, I'll include that. You know, if you have 1% in each holding, you have 100 stocks. And at some point, your portfolio becomes too diversified and looks, you know, quite similar to the index, and in which case you can have a real tough time generating alpha over and above the index. So that's the first point to make, is that this is a very lenient set of assumptions. And I think we're going to look at something which is a little bit more realistic in a bit. Yet still, you see this massive drop-off. And that is really the issue. One of the ways that asset managers can get around this, but it's unusual, what we've done is we have made our equity funds fully flexible. What does that mean? It means we don't have to hold 80% in equity at all times. We can actually defer to cash if we cannot find enough absolute value opportunities. Now, that's very, very important because if you look in the run-up to the financial crisis, there were very, very few undervalued stocks. Most of the market was actually very expensive. And in funds where you're forced to hold a minimum of 80%, you're going to be holding those equities. In a fund where you only have a small opportunity set, and of that opportunity set, they're all expensive, you're going to be forced to hold expensive stocks and put your clients at risk of permanent capital loss. So one of the things, even though we're not really big enough to even worry about this yet, but from an absolute value perspective, we have that full flexibility to defer to cash if we cannot find undervalued opportunities.
Linda, you used the word or the concept in your research called free float. In other words, the percentage of the market cap that can be traded as a maximum. We've done similar kind of studies, and some of the studies I found tends to focus on value traded. Have you looked at that? In other words, how much of the actual value that trades in the stock can be quite different to the free float of the company. So if we were to look at 10 million rand trades per week in the stock, you can trade 20% of the liquidity or the value traded rather than the free float. Do you think that would make a difference, or?
Look, it is another way of measuring liquidity, and it's a very valid way to measure liquidity. And in fact, many of our institutional clients have got rules with regards to the assets that you can invest in, which have those sorts of measures associated with them. The reality is that liquidity, however you sort of measure it, is a very real issue in the South African market, especially where we don't have much depth in terms of number of stocks available. And we've got some very big asset managers all sort of competing for the same stocks. One thing that Kobie spoke about earlier is he looked at the retail fund universe. Now, you must also remember that all asset managers, most asset managers I should say, also manage institutional pension funds, which can be as big, if not bigger, in terms of the assets that they manage than their retail fund portfolios. So there's a whole other aspect of the assets that they manage which isn't even accounted for in those numbers. So whichever way you look at it, unfortunately, asset managers do in many ways become victims of their own success. Those competing business risks and the ability to generate alpha consistently really are something that we all have to struggle with at some point in time if the business is successful.
What's your experience of this, Kobie, and your view on this in the South African context where Linda says the investable universe here in South Africa is so much smaller? Of course, the JSE, largest stock exchange in Africa, but in a global context, it is a lot smaller. I mean, how does that influence the way that people invest here? Because there does seem to be a focus on the blue chips and the top 40 per se.
Well, I mean, my experience, and certainly my research that I've done, indicates that smaller fund managers, hence managers that manage small amounts of assets, being able and being nimble with smaller assets certainly adds to long-term returns much better than somebody trying to manage a whole bunch of a huge amount of assets. And the reason for that is quite simple as well, is that the structures that you need to have in place in order to manage 100 billion or 200 billion is very different to the structures that you need to have in place in order to manage $1 billion. Yes, it might just be a different magnitude number that you're managing, but the investment teams become larger, the decision-making bodies become larger. Hence, the game changes to such a degree that often some of those managers look back and say, I can't even realize and recognize what we did that was so much fun in the beginning, and quite frankly, this has just changed completely. So I think there's a whole bunch of new dynamics that come into play. And by the way, that research isn't just been done here in South Africa, it's been done on a global basis. Obviously, the number is different globally than what it would be potentially for South Africa.
Okay, so let's talk about taking a larger position in individual stocks, because we talked about the fact that the previous graph showed a position of, say, 1% to the company. So what happens if you increase that to, say, 3%?
Okay, so I mean, this is what Linda would call her realistic set. So this means now you're trying to take a bit of an active, you want to take an active stance on a stock, and you at least want to be given that opportunity. If you have a look at the graph, what we've done over here now is we've assumed that you're not going to be taking a 1% weighting or 1% weighting in a stock. You're going to be upping that to 3%. And just have a look at what happens to the number of stocks that become available in the market. Let's start here at 50 billion. You're an asset manager with 50 billion rand worth of assets under management. What is the number of stocks that you could potentially buy? Well, it's probably only about 70 stocks that you could consider. And what about your percentage to the universe? Well, the percentage to the universe, well, that's only about 40% to the universe. Once you get to 200 billion and 300 billion, well, quite frankly, the percentage to universe, this only dwindles to about 10%, which opens up now a passive debate, which means that if you've got 200 billion as an asset manager, quite frankly, how do you manage money? I mean, Roland, have you got some opinions as far as the whole ETF industry and the emergence of that is concerned with very large fund sizes?
Look, if you're that big, you've got two decisions. You can close your fund and try and hope that you can maintain that performance. But at 200 billion rand, you are probably 20% of the total market, which means you are the market. So whatever you do, you're going to affect yourself indirectly by doing that. But what fund managers do, the two options they have is you can start reducing your bet size. So if you're going to take positions, you can't take very aggressive positions, and you've got to focus in the large cap stocks because that's where the liquidity lies. Or what you do is you start offering a core satellite approach where you actually invest some portion of your clients' money in a cheaper kind of index tracking portfolios, and then add some kind of more spicy, smaller boutique kind of alpha strategies around that where you can take some kind of position. So those are the two options. Linda, what is your view on the sort of liquidity trends? Because there's a little bit of reprieve for large fund managers in the sense that since 2002, in other words, 10 years ago, the average liquidity per quarter was about 135 billion rand, and now it's 700 billion rand per quarter. So liquidity has increased more than market cap has. So there is a little bit of leeway, more so than it was 10 years ago, to actually get in and out of these shares with more trade going through the market.
Well, one of the things that has increased liquidity quite considerably has been foreign entrance into our market. And in fact, if you look at the share market today in South Africa, a third is actually owned by foreign shareholders. Now, the problem with this is that what are the stocks that they are typically buying? They are typically buying the stocks that have already performed well. So if you look at businesses like Woolworths, like Mr. Price, like Foschini, these three businesses, their shareholding, 40% of it is held by foreign shareholders. Now, if you're an absolute value manager, and many asset managers in South Africa like to follow the value philosophy because it generates good real returns, it protects against capital loss, the liquidity is in the expensive stocks. So it's in the stocks that you would typically want to stay away from because they've done well, they've run ahead of what they're worth, and now they actually really represent risk of permanent capital loss to investors. So that tends to be where the liquidity has been. And yes, so what happens is, as an absolute value manager, you start changing your philosophy. Either you cut your sizes, as you said, either you close your fund, or instead of saying what is cheap in absolute terms, you start saying what is the least expensive stock out of my opportunity set. And that is obviously very dangerous, not only for the asset managers because their track record reflects a different philosophy, but of course for the investors who've invested believing that they're following one philosophy which is changing slightly as market conditions force it to.